Everyone. Dave Lewis here with High Impact CPA. So, it is the start of the year again, and there's a question that comes up pretty consistently from people who have either just started a business or they've been in business a couple years and they're not quite sure where to go next in their tax journey. So, maybe they're paying too much and they're starting to float the idea of should I be an S-Corp? Should I stay just a sole proprietorship? But the question that keeps coming up consistently is should I be an LLC or an S-Corp? Now, this is a response to an earlier video I made, in fact, the first video on this channel, and I wanted to go a little more in depth with it just so that there's a better understanding of what that question actually means. So, when it comes to your business entity, there's two different things that we're actually talking about. When someone says, should I be an LLC? What they're actually asking is, what should my legal classification be? So, should I be just me running my own business? Should I become an LLC, a limited liability company? Should I become a corporation? Should I file as a corporation? And these are all questions related to what your legal entity should be. Essentially, if we're just talking about an LLC, the whole purpose of having an LLC is to limit liability and protect your personal assets should anything happen within the business. Say you've got a brick and mortar store and someone has a slip and fall outside the front. The purpose of the LLC is to say, hey, person, you need to come after my business assets in the event of a lawsuit versus going after your house, your personal assets, the things that you've built that have nothing to do with the business. That's what an LLC does. It's to create that corporate veil, that protection between your personal and your business assets. Now, when it comes to what your tax structure is, that's an entirely different thing. And you'll see on the screen here, I've got a litany of arrows going from place to place to place. But essentially, your legal structure actually has very little bearing on what you're going to do for taxes because you can be just you starting out in a business and not be an LLC, not be incorporated in any kind of way. And you can still elect to be taxed in a different way. You can be just a sole proprietorship and go, I want to be taxed as an S-Corp, if that makes sense. All you need is an EIN number, which you can easily get. It's easier when you're an LLC and you've already got all the corporate documents set up, your bylaws and everything like that. But essentially, you can be a single member LLC and you can be taxed as a sole proprietor. You could be taxed as an S corporation. You could be taxed as a C corporation. So I thought it would make sense just to kind of walk through these piece by piece and really understand what it's saying from a legal structure point of view and a tax structure point of view. Because they're two different things with two very different outcomes associated. So for those of you that don't know me, I'm a certified public accountant. I own a full-service CPA firm here in Salt Lake City, Utah, called High Impact CPA. We do outsource CFO solutions and proactive tax planning for our clients, along with the normal stuff you'd expect from a CPA firm. So tax preparation, bookkeeping, all that fun stuff. So if you want to learn more about our firm, check our links down in the description. In the meantime, we'll just jump right in. It's not a particularly sexy subject, but it does matter for how you're going to be taxed for the year. So let's just jump right in. Most people, when they start out in their business journey, they're just an individual with an idea, working out of their garage, right? They haven't put in any legal structure in place, have not put together a limited liability company. Now, by default, if it's just a person or a man and a wife starting a business, a spouse, then you end up as a disregarded entity, or what's more commonly referred to as a sole proprietorship, where you're going to file a Schedule C with your individual taxes. Essentially, put a profit and loss statement together. It goes on your individual tax return, and it all gets rolled up with that tax return. So for the income tax perspective, you get taxed at the individual level. And then the other thing that you have to start considering are the self-employment taxes. These are your Social Security taxes, your Medicare taxes, and those are where things change drastically from tax structure to tax structure. For a sole proprietor, you get taxed on your net income. You pay all of your Social Security and Medicare taxes based on whatever profit you have left over for the year. Now, let's say you move down the line. Say, hey, I want a little bit of protection between my business assets and my personal assets. So you form a limited liability company. And now all of a sudden you've got a few more requirements that you've got to go through. You've got articles of organization, you've got bylaws, you've got things that make it more official to say, yes, we are a company separate from the individual. We are treating ourselves as a company and we want those protections. Well, there's a couple different ways that LLCs are formed. There's a single member LLC where, again, if it's just you or you and your spouse, you are a single member LLC, and by default, you'll be taxed as a sole proprietorship. So nothing has really changed. You're still doing the same things on your tax return. Schedule C, taxed, self-employment taxed on your net income. If you go into business with some partners, you've got a couple different people that are going to own the business. Now you're a multi-member LLC. Every person in that LLC is a member, and you get taxed by default as a partnership. Now, partnerships are a little more complicated. You're going to have an extra tax return, a Form 1065. And what happens with partnership taxation is the partnership itself doesn't actually pay taxes. You have an informational tax return at the end of the year, but whatever portion of income or loss that you have for the year, that gets passed through to your personal tax return based on the partnership agreement. So you could have a whole bunch of different things that are happening in a partnership. Say someone puts in a bunch of money up front but doesn't really want to work in the business but wants to be allocated some losses. As long as it makes economic sense, you can structure it just about any way you want. Now, from a self-employment taxation, it's still kind of the same thing as a sole proprietor. You're going to have, if you're a partner and you're actively working in the business, you might have some guaranteed payments. Think of this like your paycheck, except as a partner in a partnership, you can't be an employee. So it's different vernacular, same kind of concept. So you're going to pay self-employment tax on your guaranteed payments, and you're going to pay it on your portion of the partnership profit or losses. So a little bit different. And now the big one, the great strategy, the really, really good one that saves on self-employment tax is the S-Corporation. Guess what? You can be an LLC, you can be a multi-member LLC, you can even originally be structured as a corporation and elect to be taxed as an S-Corp. So what does that mean? It's fairly similar to a partnership, just the taxation is a little bit different. Still, the income and the loss passes through to the individual shareholders. So we'll call them shareholders instead of partners now because it's a corporation structure. But where the big tax savings typically come into play, and of course there's always nuance to it, is as a shareholder in the S-Corp, you get to be both the employer in the business and you get to be an employee of the business. So shareholder, employee. As an employee, you have to pay yourself a reasonable salary based upon your day-to-day job duties, what you actually do in the business. You've got to first pay yourself reasonable compensation. That is subject to self-employment tax. But beyond that, you can take the rest of the profits of the business out as a shareholder distribution. Now, that distribution is not subject to self-employment tax, so long as you've met the reasonable salary requirements. Little note that usually gets forgotten with the S-Corp is if you do have shareholder distributions, they have to be pro rata based on everybody's percentage of ownership in the business. So there's less flexibility than a partnership, but there are more advantages for self-employment tax savings. Now, there are more complex structures you can look at working with, partnership with S-Corps underneath it, but that's beyond the scope of this video. You can also be a corporation, any of these, taxed as a C corporation. Now, you typically won't see this as often as the S corporation because the C corporation has some disadvantages to it. The big reason you would be a C corp is if you're planning to raise a lot of money from a lot of different investors as you are growing. So you think tech startups, things like that, people who need a lot of investors, a lot of seed money coming in, you're going to have to be a full corporate structure, both from a state perspective, a legal perspective, and from a tax perspective. Uh, some of the disadvantages of the C Corp, the corporation does pay taxes. It has its own corporate tax rate. So the business itself files a tax return, pays its taxes. And there's a double taxation issue with it. If you're a shareholder in a C Corp and you want to take a dividend out of the company profits, you're going to get taxed again on that dividend at the individual level. So it's not always the most advantageous. But anyway, hopefully that kind of gets the point across of the difference between a legal entity and a tax structure. So next time you hear, should I be an LLC or an S-Corp, you can immediately go, oh, wait, those aren't mutually exclusive. You can actually be both. Anyway, if you enjoyed this content, I know this one was a little dry, but it's important information, and getting it wrong can cost you a lot in taxes. So if you like the video, please give us a thumbs up. It helps us greatly, and we will see you in the next one. Thanks, everyone. Dave Lewis, High Impact CPA, signing off.